Hey, good afternoon, everyone. We'll be starting in 60 seconds. A lot of traders are just still coming into the room. So just we'll give them 60 seconds more. Okay, good afternoon, everyone. Really thank you for coming. And just a quick disclaimer that that trading futures is associated with risk, and we don't really take responsibility for any participation or subscribers for profits or losses. We're not certified trading advisors. Take careful consideration of your financial position should you trade, and we recommend that you talk to a certified trading advisor, and that this is for educational purposes only. So with that said, this is Mark with Right Line Trading. Just a little bit about myself. I hope some of you are coming in for the first time. We have a lot of traders in the room. I'm going to show you what I think to be is the best trading system out there, and I'm going to show you how powerful it is, how it's generated multiple winners for us this week, and just why exactly it just generates such terrific entries. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for over 20 years. And I began trading the futures and Forex markets 10 years ago, stocks back in 1996. And what I did in my graduate work was the optimization of closed systems. And back then, I looked at underwater decompression schedules for the U.S. Navy. And now what we do here at Right Line, we look at each financial market as a closed system, and we look for the independent forces or variables that are responsible for the future movement of price. We place those in a multivariable equation, and then we optimize it. And it really gives us the ability to predict where price is going to move out into the future. Everything that we look at has forward-looking ability. We look at no lagging indicators. Everything that we look at is a leading indicator of price. And each, in its own right, is an independent force that comes to bear on price and helps predict its future direction. Now, the current problem with current technical analysis is that you know that 95% of day traders fail. Some people say 93, some people say 92. The bottom line is that everybody says to you, would you like to make $300 or $400 or $500 a day? Would you like to throw away your day job? Would you like to sit and trade all day? And of course you would. I mean, who wouldn't like to do that? That's the opening advertisement for everyone. If they're offering you the dream, and obviously the goal is to fulfill that promise. It's very difficult to do. And the problem with current technical analysis is that this this failure rate is unacceptable in any other field of endeavor. And the number continues to remain mired in the 90 to 95% area. Does not improve over time. And the reason is that all these new software systems and everybody who's proffering these new ways of making your daily salary, they all are based upon the same principles. That they do not look at what led to the last generation of day trader to fail, tease out the elements that are unsuccessful, keep those elements that are successful, and there's no evolutionary process in this area. I mean, essentially, all of these core systems use the same principles, and that's why for the majority of them simply don't work. And what they do is they accept current dogma without any mathematical verification. Oscillators, MACDs off your trading chart, even order flow in a sense, but if it's not leveraged appropriately, doesn't have any forward-looking ability. And if you do a Nexus Lexis search of the world literature, you're going to find that there's almost no articles published on the science of day trading. If you look at all the large universities that have big departments of business and finance, nowhere is anybody doing any really significant research on day trading. So it's really just left out there flapping in the breeze. No one publishes any scientific articles on it. Nobody's doing any research in it. And it's really been left up to us to modify these systems and move forward with them. And if you look back, people have been trading Fibonacci for the last 20 years and everyone's been losing money. They trade Elliott wave. It's the same things. And if you think that the same things that sent that last generation of day trader off the cliff is somehow going to make it different for you, I'm telling you, isn't that sort of the definition of insanity? You really have to take a look at what's going on and move in a separate direction. Now, the most important thing that you have to do are determine mathematically what are the independent variables that are responsible for the movement of price. I mean, let's assume that the price on any financial instrument, whether it be futures or Forex or stocks, is non-random. And it's based upon certain independent forces that come to bear on price to determine how it's going to move out into the future. Now, even when it moves in chop, it moves in chops for a specific, predictable reason. And if you look at every closed system in physics, the movement of all the particles in a closed system, and if you look at your kids' rooms, the movement of the dirt and the throwing around the clothes and stuff, it's all non-random. I mean, and it can be predicted. You just have to understand what forces are coming to bear on those things in that closed system. Now, the dependent variables, if you use them to help you trade, are just going to get you into losers and prevent you from taking winners. They're what throw your trading off, and they're what really hurt your trading precision. And your trading precision ultimately is the percent winners you get. It's the positive predictive value of a trade. So if you take a trade, you have a 70% positive predictive value, 70% of your trades are going to be winners. If you use the oscillator on your trading chart, it's going to throw it off. And I'm going to show you that. The MACD, it's going to throw it off. And if you do Fibonacci and classic Elliott wave, it's simply going to degrade the precision with which you trade. Independent variables truly lead price. They help determine where price is going to move. Now, the first one that we have determined, which is really one of the strongest, is the multi-time frame analysis of trend. When you have multiple time frames that are trending in the same direction. You sort of have a lock, and you want your software to tell you that because you want to trade in the direction of a multi-time trend, in a multi-time frame trend, excuse me. The other is the multi-time frame direction of correlative markets, which is in essence money flow. When money is flowing in the same direction across multiple markets and multiple time frames, that's another time that you want to trade. Now you want to look at order flow, but you have to look at it on a multi-time frame basis, and I'll show you how we do it. It's a lot different than really I've ever seen it assessed before. You also want to look at the multi-time frame analysis of momentum, is when you get momentum locked into the same direction on multiple time frames. It's going to also help you predict the future movement of price. And you also want to look at the multi-time frame analysis of market profile. The market profile is a really powerful indicator, but if it assesses volume from your trading chart only, it's just simply not predictive enough and not powerful enough. So let's go through all of these relatively quickly, but I want you to see how powerful each of these are in predicting how price is going to move out into the future. Now, 3 of them are momentum, stochastic, and order flow, and they're embodied in this 3-line indicator. The top line is momentum, the middle line is stochastic, and the lower line is order flow. It's one indicator, but it does a multi-time frame assessment of these variables, and we're going to take each one at a time. Now, if you look at order flow and you look at the delta of every candle, the delta is simply the imbalance in aggressive buyers versus aggressive sellers. Now, it's an important metric because in general, an up candle has an overabundance of aggressive buyers, and a down candle has an overabundance of aggressive sellers. Now, this is the way that most charts assess the delta. They simply look at the absolute value of each number. And when you see this big negative number here, drops the delta. This positive number pushes it up a little bit. This negative number pushes it back down again. So all it's doing is giving you the delta value of each of these candles. And it really doesn't tell you where price is going to go out into the future. Now, and here's the reason. You can get a negative delta on an up candle and a positive delta on a down candle. You see, this is a down candle with a positive delta. And here is an up candle with a negative delta. So if you just use this as an assessment of the direction that price is going to move, you can really get misled. Because in general, an up candle will have a positive delta, and in general, a down candle will have a negative delta. But those values can be skewed by an outlier, and an outlier is when you get the reverse. Is when you get a positive delta on a down candle or a negative delta on an up candle. So what can you do about that to make the delta predictive and kick out those occasional outliers and not skew the data? So what we do is we look at the delta moving average of your 2 higher time frames. So if you're trading, say, a 3-minute, it's going to take 3 time frames longer, or 9 minutes, and then 3 time frames longer than that, 27 minutes. It's going to take the delta of the candles on the 9-minute, and it's going to place each of the delta values into a 15-period moving average. The moving average smooths the data. So if you get an occasional outlier, it won't skew that moving average significantly. And you've got two moving averages. One is the next higher time frame, and the other is the higher time frame still. If you're trading a 5 range, it's going to look at the next two higher fib numbers. It's going to look at the 8 and the 13. If you're trading a tick chart, like a 377 tick, it's going to look at the 610, and then I think it's the 900 something tick chart. So it creates two delta moving averages. Now, when those delta moving averages, now we eliminated the blue color since I made this slide and the orange. It's either going to be green or red or yellow. So this would be all green. So when the two delta moving averages of the two higher time frames are long or heading up, price on your trading chart is almost always going to rise. And when the two delta moving averages on your two higher time frames are moving down, price is always going to fall. This single indicator sets an absolute direction that you have to trade. And this is only one independent variable. We still have multiple others to look at, and they all have to be in sync for you to take a trade. Now, the reason I put this at 0 is because we don't care what the delta is on a candle on your trading chart. We know that that's as likely to mislead you as it is to help you. And if that's the case, that is information that we don't want to use and we don't want to assess with our trading. We only want to look at the delta moving average of the two higher time frames. And it has tremendous predictive power. It doesn't give you an entry, but it keeps you from doing what all of these traders are doing, taking these trades in the counter trend direction, in which they're almost always going to get stopped out. Here's just another example. I'm going to show you a market profile, but this is an area of support and resistance created by market profile. Traders, software vendors are always talking about areas of support and resistance, supply and demand. Well, market profile creates the best areas of support and resistance that you can create. And I'll show you how we do it. It's really a little bit unique. But when you break resistance, you take a long trade because the delta moving average of the two higher time frames shows you that there's significant buying pressure on price. Here's just a trade I took, 18 ticks to the downside. There's other things that you have to take into account, but the delta moving averages are both aligned to the downside. Now here's a little bit of a better example. You break support. The delta moving averages are both red. You can only go short to support. There's a support of the point of control. You can let price jiggle around here until you get set up for a great trade. When price breaks support, comes up and tests resistance, you go short. And this is not a long trade yet because because order flow tracking is not telling you that there's a predominance of buying pressure. Same thing here. Come up through resistance, sit on support. You've got a long trade all the way up to resistance in the direction of order flow. And I just wanted to use a slide to exemplify the fact that when you sit on support, up in the direction of order flow, back to support, long, back to support, long. Now, we do take counter trend trades in the live trading room, but we're really careful to wait until order flow turns. If you don't, you run the risk of getting run over. You always run the risk of getting run over on a counter trend trade. It's always more dangerous. But if you don't let order flow turn, and I'm going to show you the live trades I took yesterday and today, you're going to see the counter trend trades are always in the direction of order flow. Price comes down to support. You anticipate a bounce and you get out. In this particular case, price just smashes through support. Your next potential trade is a move up to resistance and then a continuation short. That would be what you would hope would happen. Now, I wanted to show you here the MACD. Now, if you look at the MACD in your trading chart, you see what a really poor tool it is for predicting the future movement of price. Quite frankly, it's quite lousy. And traders are constantly using it. Now, stochastic divergence, I'm going to talk a little bit about the difference between MACD divergence and stochastic divergence. But here's divergence. Price is making a higher high. Divergence makes a lower high. You anticipate a short, and you get run over. And look at what happens here. Price makes an equal high. The MACD makes an enormously lower high. And price just comes down a little and then runs you over. Then if you trade this MACD crossover, which is this black line, you're just going nowhere. Price comes down to support and then just heads right back up again. So whatever the MACD is telling you on your trading chart, it will get you into some good trades, but it's going to cost you an enormous number of losers. And remember that day trading is never about the number of winners you take. It's always about the number of losers you take. You can take a lot of winners trading in a single morning, but if you take a few big losers, you're going to wind up losing money. So you have to trade with incredible precision and patience. And you can see that these signals are just not going to do it for you. So what we've done is we have retooled the way we assess the MACD. Now, we use the MACD as our momentum-based tool. And the MACD really does give you a good assessment of momentum. But what we look at is we look at the slope of the MACD line. Here's the signal line. And we don't necessarily care if it crosses over. And more importantly, we don't look at the MACD on your trading chart. We look at only the two higher time frames, because it's the two higher time frames that lead price. Just like the delta moving average, the momentum of the two higher time frames, it's what are going to determine where price is going to move out into the future. It's not, we don't use any data from the trading chart. We assess, as you're going to see, other markets or the two higher time frames. Nothing comes off of the trading chart and price. So here now you have two lines. The lower line is order flow and the upper line is momentum. And momentum is simply the slope of the MACD line of your two higher time frames. Now, these are equally important. They're co-equal forces. So they have to align for you to take a trade. So when order flow and momentum are aligned, you look for a break of resistance and a long trade. Now, I took the time frame out and I took the instrument out, because I want you to realize, and it's very, very important for you to know, that it doesn't make any difference whether you're trading futures, Forex, or stocks. And it doesn't matter what time frame you're looking at. If these are true independent forces that govern the direction of price, then they are time frame independent and they are instrument independent. They'll work just as well on the pound dollar as they will on trading Netflix, as they will on trading crude oil or they will on the E-mini S&P 500. If they don't work on every time frame and they don't work on any financial instrument, then they're bogus. But they do. And you can see when they're aligned to the upside, if you don't take a long trade, the probability of you getting stopped out is exceedingly high. Now, I want to show you what happens when these two independent variables don't align. You have momentum to the downside and order flow to the upside. And that's why price moves in chop. And you can see right in here, when both of these equal independent forces are telling price to move in opposite directions, price just chops around. Once they move into sync on your two higher time frames, you've got yourself an enormous short trade. And we haven't talked at all about entries. We've just talked about directional bias. And believe me, although it's not 100%, making sure that you trade in the right direction is about 60 to 65% of the trade. Again, no alignment here. And price just chops around. Finally, it aligns, breaks, and you've got a long trade. Now stochastic, it's an elegant indicator, but here stochastic divergence is not quite as bad as MACD divergence, and we have it programmed. But what we've done is we made the analysis of the stochastic indicator easier. And here's how we do it. Remember, we don't look at the stochastic on your trading chart. We look at the stochastic of the two higher time frames. And that's going to be the middle line. Now here's stochastic divergence. It's the same divergence that you saw in the instance of the MACD. Equal highs. The stochastic makes a huge divergence signal. Again, it just gets wiped out and price comes right back up. So you definitely don't want to counter trend trade on the basis of a divergent signal that comes off of the MACD system or the divergent off of stochastic. It'll occasionally give you a winner, but it's going to walk you into a lot of losers, and that makes it a useless signal. Now, it turns out that stochastic on the higher time frames, based on our assessment, and we do 2 years of market replay data to assess it, has some validity. So here's how we programmed it into the line. Made it real simple. The middle line, when the oscillator is overbought, the line will always stay green. When the oscillator is oversold, it'll always stay red. Now, in between overbought and oversold, the color of the oscillator line will be determined by the position of the oscillator versus the signal line. When the signal line crosses below it, it goes red. When it crosses above it, it goes green. But in a strong uptrend or downtrend, a potential divergence signal on a higher time frame is going to trigger a color change in the oscillator line in a place where it just should not change color. And I'm going to show you an example. Right here, the oscillator goes green. Goes red in the middle of a move. And it's just telling you, it's sort of a little bit of a warning, which I've sort of learned to ignore. Because when you have momentum and you have order flow bracketing this oscillator divergence signal, it's almost always going to get run over. And it may turn out that we code it out, but right now it's there. And you can see as soon as the divergence signal fails, it goes right back to green because price is not going to fall. So we do have it coded in. Sort of an orange yellow light. And it's really helpful if you're not in a trade and you're thinking of taking an entry. But if you're already in the trade and you're thinking about exiting, don't exit on the basis of the divergent signal. But if you're thinking about taking the trade, then maybe it's incumbent upon you to step aside on the trade because it has slightly increased risk. Now, another assessment that we've made, and I don't want you to have to overthink this 3 line. That remember I told you that it looks at the slope of the MACD line and not at the crossover. But I kind of misled you. When the MACD line crosses the signal line, it turns green. But the MACD line may take a little bit of time to turn. So what we did was to make it very easy to assess, because we're looking at 3 complex indicators together on 2 higher time frames, and we want to get into the trade with the best possible probability of success. So if you look at the candle halo is outlined in the color of the alignment of the 3 line. So you don't even have to look at the 3 line. Just look at the candle halo outline. Now this candle halo outline is what I choose. You open the indicator, you can outline your candles in any color you want. You can make an up color green or whatever you like. Now it's going to give you an up color if stochastic and order flow are green and momentum is yellow. It's still going to signal a long trade. If order flow and momentum are, if stochastic and order flow are red and momentum is yellow, it'll still signal a short trade. So all you have to do is follow the colors that surround the candle to give you the multi-time frame assessment very accurately of momentum, stochastic, and order flow, taking into account the MACD line and signal line, the oscillator line and signal line, the delta moving average of the 2 higher time frame. It does a complex multi-time frame assessment and really does get you into great trades. And this pullback right here and this continuation, this pullback right here and continuation are terrific trades. Now here's the same, this is actually a different trade, but it's the pullback and continuation, pullback and continuation, pullback and continuation, pullback to support throughout this whole move. The 3 line is green, green, green. And I'm going to show you my live trades today and yesterday. And you're going to see that when you trade in the direction of the 3 line, it's really helpful in guaranteeing you a winner. Now here I just changed the halo color just to show you that you can change to make it any color you want. And you're going to trade in the direction of that halo. And when there is no halo, when it's black, it means there's no alignment of the 3 line. You're going to stand down and not trade, because any trade you take is going to be associated with increased risk. And as day traders and swing traders, we avoid risk like the plague. We don't want to take a chance on getting stopped out. I just changed the color again. Now the multi-time frame analysis of trend. I don't want to have this go too long, but I want you to see all the assessments that are being made. Now, here's crude oil, and you can see that the price is falling. Now this pink background bias is really important, because this tells you, again, we don't look at anything that's happening on the chart. Price movement on the chart is irrelevant. What we want to do is predict how price is going to move on our trading chart. So what this indicator does, it's called our bias indicator, is it looks at the trend on the 2 higher time frames. And if you're trading a 3-minute, it looks at the 9 and the 27. Trading a 2-minute, it looks at the 6-minute and the 18-minute. If you're trading a 5 range, it looks at the 8 range and the 13 range, and it looks at a number of different variables to determine and make sure that price is actually in a downtrend. It looks at the 50-period moving average, and it looks at our 15-period proprietary moving average, which I'm going to explain to you briefly later. When the 15 has crossed the 50 to the downside, and the 50 and the 15 are red, and price is below both, so price is broken support, the background color goes pink. It doesn't care what price is doing on your trading chart. It only cares what price is doing on your 2 higher time frames. And you can easily see how the trend on your 2 higher time frames are going to lead price on your trading chart. And I'm sure all of you have seen multiple software packages that have this background color that go on. Well, all that background color is assessing price on your trading chart. So when price falls, it goes pink. So who cares? We already know that it's falling. But we want to know what's going on our higher time frames. And you can see when it's pink, you can only take it down a short trade. And any long trade is almost guaranteed to get stopped out. So now we're adding more specificity to our trading methodology. We need order flow, stochastic, and momentum to be aligned to the downside. And we want the multi-time frame analysis of trend to be aligned to the downside. As we layer this, we make it tougher to get a trade, but when we do get one, the probability of getting a winner rises higher and higher and higher. Now here's the same thing to the upside. The multi-time frame assessment of trend, this is on the E-mini. The 15's cross the 50 to the upside. Price is above the 15 and the 50. The 50's green and the 15's green. And the size of the move is irrelevant. This could be 3 points. It could be 1.5 points. All that matters is that the probability of getting a winner is extremely high. That this is a low risk, high reward trade. And although I don't have order flow and stochastic and momentum, I can tell you they're all aligned to the upside. Now, correlative markets are really important. I mean, I blew the NASDAQ, the E-mini away this morning because I will only trade it when the correlative markets, which are an assessment of money flow, are in our direction on the trade. I also want the 3 line, and I want the multi-time frame direction of trend to lock for to the upside or downside. But a lot of packages, a lot of software claims it can track money flow, but that's a very, very difficult metric to track because there's no absolute way of being able to determine where money is moving in the market. And no way to do it. It's very difficult to do in a way that provides you with forward-looking ability. But the way we do it does. And what we've done is we know that when the NASDAQ falls, the E-mini and the Russell are going to fall. And they correlate with each other. So either 70% of the time or greater, the NASDAQ, E-mini, and Russell will move in the same direction. And 70% of the time or greater, Treasury bonds and Treasury notes will move in the opposite direction. Now, this is just a small analysis of multiple markets that either move in the same direction or in the counter trend direction. And what this shows you is what institutions do throughout the course of the day. They rotate their money from asset class to asset class as they make an assessment of risk. When risk is on, they're going to buy stocks. And when risk is off, they're going to sell stocks and move into bonds, notes, certain precious metals, certain currencies. So money is going to come out here and go here. This is the way that we assess money flow. It's very accurate. And when you take a trade in the direction, you'll see, of a lock in our indicator system that assesses money flow on the E-mini, it's very powerful. Now, here's an example. And this is on bonds. Now, there's 6 correlative markets, 3 in each line. And when money flow is moving into bonds, bonds are going to rise. Money flow tells you that bonds are going into bonds. Bonds rise. Now, this is not looking at a higher time frame. It's not even looking at bonds. It's looking only at its correlative markets. So this is an assessment of completely different markets than bonds. And when there's no institutional money moving the market, and these lines are yellow, price chops. When only one correlative market is yellow, price chops. So you only want to trade in the direction of institutional money, in the direction of a multi-time frame trend, and in the multi-time frame direction of order flow, stochastic, and momentum. So you see, we're making the trade more and more specific. We're constraining it so that you're going to get fewer signals, but when they occur, the likelihood of getting a winner is becoming higher and higher. Now, I showed you that same move. Oftentimes, the multi-time frame alignment of trend is associated with big institutional money. Now, we have 9 correlative markets on the index equities, the E-mini, the Russell, the Dow, and the NASDAQ. And they're in here along with a lot of other markets. There are 9 here. And you can see money flowing into the E-mini, up it goes. Money flowing into the E-mini, up it goes. And again, these lines are in green because price is rising. These lines are green and they're pushing price up. I'm going to skip that. Now, market profile, I don't want to spend too much time on, but it's really based on sound math. Because if you take the random distribution of any set of data in a closed system, it creates this bell-shaped curve. And the mean value right here in the middle is bracketed on both sides by 1 standard deviation's worth of data, or 66 2/3% of all the data. In the market, this is price. So 66 2/3% of all volume at price is wrapped around the mean price, except that in the real world, the distribution of data is not a perfect bell-shaped curve. And what it is it's a skewed curve. It's a modified bell-shaped curve. Now, the point of control is the price that is most commonly traded. There's more volume at price here than at any other price. Traders love this price. This does a multi-time frame assessment. Goes back 2.5 days. So for the last 2.5 days, traders have wanted crude oil at $53.49 more than at any other price on the trading chart. And fair market value, which is 66 2/3% of all volume at price, is bracketed by the value area high and the value area low. So these are clear-cut forces that govern price, because the point of control is a price attractor. Price wants to move towards the most oftenly traded price. If you talk about regression to a mean, you can talk about regression to a moving average, but you can also talk about regression to the point of control. When price goes up to the value area high, it's going to get repelled down back into fair market value. When it moves down to the value area low, it's going to get pushed up back into fair market value. Now, there are also low volume nodes. Now, these are just the opposite of the point of control. And these are prices where almost no volume is crossed. Traders hate this price. So at 23.46, traders do not like to trade the E-mini. And at 23.40.25, they do not like to trade it here. So you have price hitting an area down here and up here that repel price for two different reasons. One, to stay within fair market value, and two, it's hard to cross a price that has very little volume. So what it creates are zones here of rejection, we call them. Now, what's important about our market profile is it moves and recontours itself intra-candle. Because if you're trading a 3-minute candle or you're trading a 4-hour candle, we have some traders who trade daily candles. You do not want to wait 4 hours or 8 hours to market profile to tell you where it is. You can't take a trade waiting 4 hours to tell you where the value area high, low, point of control is, and these low volume nodes. With our market profile, it changes with every single change in that histogram. So intra-candle, you can get multiple times where the point of control and these value areas are going to move. And we don't trade up into a zone of resistance, nor down into a zone of support. It increases risk. And you see here, price comes up, hits, and gets rejected. And what I see all the time is price will come up to the value area high, hit it a couple of times, get rejected, and what happens here happens. It simply collapses. And what you do is you look for a pull up into a zone here that's a zone of resistance, and then take a short trade. As long as you have the multi-time frame assessment of trend, order flow, momentum, and stochastic in your direction for a short trade. Now here's the same thing. Now you can just see you've got your support and resistance zone here. I don't have to go over this again, but you use this to trade long, and you wait for the break of support here to trade short. Now, this is these are Sierra charts, but what we also do is we look at the point of control of every candle, because the point of control is not only important on a 2 or 3 day basis, it's also important intra-candle. Now, the point of control is this yellow outline. That's the only tick value we care about. Now, on a future, it's a tick value. On a stock, it's a particular price value. It's a cent. On a Forex chart, it's a pip value. On a long trade, we want that point of control to be at the bottom and push the trade up, anchor it. On a short trade, want that point of control to be at the top of the candle to push it down. Here's the point of control at the bottom, and the trade goes up. Now this is the value weighted, the volume weighted average price, the VWAP. It acts as an area of support and resistance. I don't want to make it too complicated, but this will help predict whether it's going to get broken. If that point of control is at the base of the candle body or way down at the bottom of the candle, it shows there's a lot of buying pressure here. It's going to help push that trade right through to the top. And we're trying to leverage everything we can to allow us to trade with as much precision as possible, because we know that we don't want to take a loser. Now, the last I'm going to show you is an indicator that's unique for us. Nobody else has done this, and it's made our desktop, our workspace complex, but it's very simple to read. When I made the slide, it was 21 indices, but now we've dropped it to 16. Now, what we do is we assess the direction of the cash markets when we trade the index equities. Like when I look at the S&P 500 and I want to take a long trade, I'd like to take a long trade in the same direction as the cash markets, even though I'm trading the futures markets. It's real powerful on stocks, and it helps us for futures. And what it does is it looks at 16 internals on these markets. It looks at these are all the different metrics it looks at. Now you need a second data feed. This comes off of a kinetic data feed, because it's unlikely that your futures data feed is going to provide you with the kind of cash internals that are required to drive this indicator. And it looks at the ratio of, some of them are the ratio of up-down volume, the advanced decline line, the uptick, stocks upticking versus downticking, advanced declining on specific ETFs, upticking and downticking on specific ETFs. And what we get is the upper line is all the tick data, and the volume data is here. So you have 6 tick metrics and 6 volume metrics. And for some reason, the tick data tends to change color faster, and the volume data tends to change color much slower. I don't know why that is. I don't want to. Now these are stocks, and you can see these are the cash metrics. And when they're green, and you can see the background is green, and the 50 is green, and the 15 is green. This is a great long trade on stocks. For 10 cents of risk, you get 40 cents of profit, which is an amazing risk to reward. Here's on Perigo. These are the cash metrics right here. It's 75 cents on this trade on 10 cents of risk, trading right off the value area high for a long trade. Here's Tesla, short for 65 cents. You know, we don't do that. We don't play that game of, you know, trading the open and taking a small biotech and looking for a breakout. I think that's all phony, and I don't believe anybody does it successfully. We trend trade stocks with an enormously positive risk to reward. Here's $1 of profit on 15 cents of risk on Netflix, trading in the direction of the cash internals. And this is a Akamai on a 1-hour chart for $1.05. Garmin, a gigantic long trade. NVIDIA, short trade. Now, if you're so inclined, it will help you to trade gaps. You know, you've got a lot of these people telling you that they know how they can evaluate a gap, and they give it blah, blah, blah. Well, if the cash internals are aligned to the upside and a stock gaps up at the open and the cash internals are aligned to the upside, that gap is likely to continue up. It gives you a scientific assessment of the likelihood of where the gap is going to move. And the only thing I want to say about gaps is whatever happens pre-market, that traders say allow them to evaluate the quality of the gap is irrelevant. The pre-market gap is created by retail traders like you and I, and we really don't count. What happens is when the market opens, the professionals and the big money move in. So you can't tell what's going to happen pre-market. You have to wait till the market opens. But if the cash internals are screaming by, this gap is very likely to move. That's a really complex gap that I'm not going to really talk about. Here's Console Energy, a long gap up on a 60-minute chart. I'm not going to talk about that one either. Here's 9 points on the NQ in the direction of the cash metrics. And that's on a 3-minute chart. Here's on the E-mini, 9.25 points in the direction of the cash. Now remember, this is the E-mini futures trading in the same direction as the internals on the S&P 500 cash. Nobody else does that assessment, and it helps. Now here's a market open trade on the E-mini. I rarely take these, but you can if you want to take the risk, because at market open there's a lot of imbalances, and these things can shift color rapidly. But if they're aligned to the upside, you can trade the E-mini to fly up to fly to the upside. Now let's take a look quickly at the actual entries that the system gives you. This is a strategy entry. It's a multi-time frame assessment entry. We only take smart entries. It looks at 3 time frames. It looks at market structure and price action. And you can see throughout here, it never fires. It waits for the 50 to be red, the 15 to be red, and it waits for a pullback to resistance on a short trade. Now, if everything else is aligned appropriately, you're going to take this entry short for a real low risk, high reward trade. Here's a long trade, and here's a short trade. This one's a little riskier because the 15 is just crossing the 50, and the 15 hasn't rolled yet. It's still green, but this is a multi-time frame assessment signal. So it's telling you that the 2 higher time frames are aligned for a short trade. And so you can take that trade short, and that right here on this is an intra-candle signal. It's easy to place this trade at the close of the candle. You're in 1 tick above, and up you go. Now the ABC entry is the only one that does not do a multi-time frame assessment of the actual structure of the trade. All it's looking to do is catch traders in the counter trend direction. Now the A is printed by the software. Anytime you get 2 candles in continuity of the same color, you have a trend. So you get the A, and the A is printed by the software. Then when traders trading oscillator divergence or MACD divergence take a long trade in a short environment, they're almost always going to get stopped out. The C starts to flash. It's an engulfing candle. It's going to give you an audible alert, and you're going to put your entry 1 tick below the close and wait. If the candle engulfs and gives you your entry, you'll take it. If it doesn't, the trade is canceled. And what it does is the market gets pushed down by 2 forces. One, you're moving in the direction of institutional money. But secondly, all the traders in this counter trend direction who are long are going to get stopped out. And as they get stopped out, they have to sell their contracts to cover their position, and that's going to help push this short trade down. Here's another C, very low risk, high reward trade. There's a long C for 36 and a short C for 36. Now the consolidation entry is one of my favorites. It's really a good entry. It's also a multi-time frame assessment. What other software has to do is wait for the break of consolidation. Our software makes an assessment based on the higher time frames and predicts the break of consolidation before it happens. And you can see these blue and yellow channels. That's created by the software, not by me. I didn't draw it in. And you can see multiple channels here, but there's no signal because you're not trading off of support. So it's a smart signal. Now, what happens in consolidation is volatility drops and the power of the bulls equals the power of the bears. So you get 2 up candles, you get an up candle and a doji, a down candle, an up candle, a down candle, an up candle. If you took this break of consolidation, it would have taken a little heat. This second one that fired intra-candle was a better one, but you don't know that's going to happen. You're in on the first, and you've got yourself a great move. Now, this gets pushed up even more powerfully because you've caught more than one candle in the counter trend direction. So the longer the period of consolidation, the more power it's like a spring. It tightens and tightens and tightens as more and more traders are caught in the counter trend direction. When you get that signal that the software is predicting a break in consolidation, you're in one tick above and you're in one tick you're in one candle before everybody else. There's the same trade. And this is not a trade we could take because we have to wait for the 15 to cross the 50 to take a long. But it's a consolidation signal nonetheless because it's trading right off support. And that's not a trade we would take. I just wanted to demonstrate it. Here's the short for 10 and the long for 40 out of consolidation. And here's the consolidation signal in the direction of order flow and the cash metrics. I don't really want to be redundant here because I want to show you our live charts. These are just multiple trades, this is the Forex. There's the pink background bias that tells you of a multi-time frame alignment to the downside. This is a strategy entry. Everything is aligned, and that trade is it's a 43 pip trade. It's a $655 trade. So it trades, here's the pound dollar, 52 pips to the upside. Here's Netflix. It doesn't really matter. Here's Apple. Now, before I'll show you a few testimonials, but what I want to do is I want to go to the software. Now, here's the software. Now, if you look at that trade right here, you get these trades all the time. That is a trade you can take to the bank. Now, it isn't to a pivot. So you have to make a decision as to whether or not you think that the pivot's going to break. It's always a difficult decision. Now, I'll anticipate the break of a pivot out of consolidation. And you can see the consolidation signal here. Here's the 3 line. I'm sorry, these are the quant lines. I don't like this. I don't like to put the print in here because it kind of distracts me sometimes. But this is order. This is money flow. Red, red, red. Here's the 3 line. Red, red, red. Here's the cash metrics. Red, red. Everything is red. When you have 8 reds on a consolidation entry, even though it's into a pivot, you're going to take it. And you have a down background bias. I didn't go into there are 3 down colors and 3 up colors. I didn't want to take the time to go into them, but they're all good. That's a 4 1/4 tick trade. Now the market's oversold. I'm not going to go into how we do overbought, oversold, because I don't want to run over. We have a great oversold. That's a 28 tick difference between the 50 and the 15. Well, these are not short trades. Now, here's another short trade right here that you could take. Now you have 7 red lines. You don't have the stochastic. I'm sorry, you don't have the intermediate quant. This is order flow. The 3 line is red. The 2 cash metrics are red. You have to determine whether you want to take a trade with incomplete money flow in your direction. This is the major determinant of money flow and the minor. You don't have the intermediate, so the trade has a little bit more risk, but it's definitely still an entry. Right here. And it's a great trade. Now, this is risky because you don't have any background bias, and you only want to trade with background bias when you have that multi-time frame alignment and trend. Now, this C candle is a tough trade, and I wouldn't have taken it. I'll just tell you right now. You've got the 3 line, but I only have one of the 3 indicators of money flow, and I want to have more than that. And standing aside would have cost me a nice trade, but I wouldn't have taken it. If I see any losers, and here's your, and these are your real conservative winners. Look at this trade at 11.52. You have the best long, not 8 green lines up. And you have a winner. You have this trade, this one I would not take because the major indicator, this is a major quant, intermediate, and minor is red. I would have stood down on this trade even though it would have worked. And here you have it again, right here. When you have 8 green lines trading out of consolidation, right here, you've almost, I'm telling you, you've almost got a trade that you can take to the bank. You have money flow, momentum, stochastic, order flow, and the cash internals are all hard up. Same thing here. It's a real easy system. And I'll show you the trades I took this morning. And we were out of the room by the time these trades developed. I took this trade right here, was right off the value area high. I'm sorry, this low volume node. It gave me some heat, but I had order flow. I had money flow in my direction, the 3 line, one of the cash metrics, not both, and I went up for 2.25 points. Then my other trade was right here. This was a beaut, right here. Now I want you to know that when you close the system and reopen it, it shifts colors a little bit because on a fractal analysis is done a little bit. There's really a flaw in the platform, and it shifts everything to the right. But this was taken with the 3 line. This is long bias on a multi-time frame basis, and this went 4 points. Now I missed this short trade. It didn't have background bias, but it should have been taken. And then I took this counter trend trade. Remember I said you can take a counter trend trade when order flow changes? Look at the halo of the candle. It's pink. I've got the 3 line with me. I've got one of the cash metrics with me, and I took it for 2.25 points. This trade I could have taken, but I was just a little bit fearful of it because I want that 15 to cross the 50 to the downside before I'm going to take a short. And I stood aside on a big winner, but it didn't matter. I'll show you today. Here's how he did in the room. He made $612.50 today on 3 trades. And you can't do better than that. Now I'll show you yesterday. Now, these are trades that we weren't in the room, but look at that trade. That's unbelievable trade. That's 5:15 in the morning. Now, when you trade without any background bias, you see there's no multi-time frame alignment and trend. And you can see how the market just moves in complete chop. You wait for these time frames to align. Now, this is the middle of the night. And the other problem with Ninja is it doesn't assess the background bias sometimes when you go back a few days because it just has a flaw in it. And here I'll show you the 3 trades I took. Here was one, the counter trend short. Now this did have the 3 line. It doesn't have it anymore because I've closed and opened the platform, and Ninja Traders jumbled the fractal analysis for 2 points. Then this was a long trade with background bias for 1.25 points. This was a long trade with background bias You can even with the jumble, you can still see here. I've got the 3 line. I've got the intermediate, the major, intermediate, and minor quants. I've got the 2 cash for 2 3/4 points. And yesterday we made just under $600 too. So you're $1,200 in the last 2 days. And we have traders who stay in the room and they continue to trade, and you're going to continue to get these signals. Now I'll show you real quickly on crude. I mean, this is just not an entry. I'd like to tell you it would have been a tradable entry, but it's too far off support. It's a C candle, but you're not going to trade a C. If you look at the point of control, all the way at the bottom of the candle, just where you want it, but you have to trade off support. So there's a short trade, but a very risky one. Now, here's a great example of how the indicators lead price. I want to show this to you, and then I'm going to stop and see if there are any questions. So I don't want to run too far over. I don't want to bore people to death here. Price is moving sideways. Nothing is happening on this chart. And it's moving sideways right off the point of control. And it's really moving in consolidation. You don't get a consolidation signal, but you can read price. And clearly you can see you've got an up candle, a down candle, a little down candle, a double engulfer up candle, a down candle, an up candle. But look what happens down below. The higher time frames are moving. And the 3 line turns green, telling you, go long, go long. Now, the best place to go long is as you approach support at a consolidation. Now, if you went long here, you would have taken a lot of heat because you're not trading off support. But if you go long here, you've got yourself an incredible trade. It's called in advance because the software is a leading indicator. And this is a great example of how it leads price. It's calling a long trade before the long trade even occurs. And that does not happen on any indicator. That simply, if this was an oscillator or a MACD, it would flatten just like price flattens and would do nothing. And this is a terrific trade. It's a 33 tick trade. Now let me go back to the slides, and I could show you this on every. It doesn't matter. I mean, I could move this to stocks. I could move this to Forex. If I covered this up, and you did not know what this was, you'd see the exact same stuff. This has nothing to do with the fact that this is the E-mini and crude. It could be gold. It could be bonds. It could be notes. It could be heating oil. It does not matter. It could be Netflix, Facebook, the euro pound. You get the exact same signals. Now, I'll just show you the offer, and then I'll see if there are any questions. I have to go to the bottom. It's a really good offer. Mr. Marketer, but it really is. Now, I just wanted to say we have two. Trader D, who's in our room, he's in the room today. He was the Top Step 2016 Trader of the Year, and he just talks about how great the system is and how he went 21 straight days without a loser. He's one of our best traders. Jersey Tony is also in the room every day. These guys make a lot of money and they trade a lot of contracts. And there's Trader D. I took this off a Top Step. D Moore, #1 in the $50,000 combine. He beat everybody out in 216 for profit. So here's the you get the full indicator suite. You get all upgrades and add-ons for life. We format the whole thing for you. I didn't even go over our trade execution platform, which is really a shame. I'll just show it to you. I know it's a pain. Maybe I'm showing you too much, but they're here. And so it's right here. This allows me to trade so much easier than the dome. Like if I want to take a long trade, all I have to do, and this is patent pending. A lot of people say, patent pending, but we really do have a patent pending. If I want to buy, I just hit it. And this is going to execute the trade one tick above the close to the upside. Now, it won't cancel until the market moves a tick, and the market's locked. It just canceled. If I want to take a short trade, I'll sell on a down close. I can close. I don't have to chase price. This chases it for me. If the exact closing price is going to be a little bit different, this will do it for me. I do not have to chase it around. It's a real sophisticated tool, and it's a great way to trade. I would never trade without that thing. And we're putting that in the package. So if you're in the trading room and I say buy an up close, I'll give you the price. You just kind of press the button. Instead of chasing the Superdome or the static dome and trying to find the price. You also get a month in the live trading room with me, and I'm really going to show you how to trade with patience and discipline, and you'll make really good money. It's actually 10 weeks, not 12. It's trading school. And you also get our video tutorial library. Then we have about 250 videos we don't show to anyone else. Now, on the first 5 orders, you're also going to get the automated system, which trades the exact same signals that I showed you. Now, I have the results. I have to find, let me see if I can get the link. It trades the E-mini crude. It trades the 6E, the 6J, the 6C, gold, the NASDAQ, the E-mini, and crude. It trades 8 markets. Today, it only took 1 trade, 1 winner. It's a very, very choppy market, but it really looks to preserve your capital. It rarely takes a loser. And when it takes a winner, and it really is just looking to get in on a trade in which every single independent variable that I outlined for you work. Now, if you hang on 1 second, let me see if I can get a link. Hey, Rory, can I get a link to the results? What? Hang on, Rory's going to put it in the chat box. And I'll show you the results. Hang on for 1 second. Now, it's $29.99 or 2 payments of $15.50 a month apart. And you're going to get the whole system and the automated system. And I'm telling you, this makes money. And these trades are all taken live. I'll wait for the results. The 613. I'm just hang on 1 second. All right, listen. Let me see if while Rory's doing that, let me see if there are any questions. So I don't want to hold you guys up anymore. I know it's I'm running over time, and let me just go down to here. Here's our number: 786-713-5276. If you want to call us, hang on 1 second here. Okay.
You're in the chat box.
Okay. Hang on. The results should be coming up in a second. Now here are our results. Just under $50,000 from January of 2016 to today is our cumulative profit. In 2016, we just started it. We made 16,500. 2017 was a full year. We made 33,000. Over the 2-year period, we've made almost 50,000. For most of this time, we traded 2 contracts. Now we're trading 2 on some instruments and 4 on the other. Cumulatively, it's taken 73% winners and 27% losers. And this actually goes over on each day. If you really want to take a look, you can see actually the trades that are taken. There's the euro, the yen, the pound, the Canadian dollar, gold. These are the trades on a daily basis. If you want to go through that. And here's the cumulative winners and losers. And these are our most liquid. Gold is our most successful, then the NASDAQ, then the E-mini, then the 30-year, then the pound, the Canadian dollar, euro, and the yen. Hang on one sec. Hey, good afternoon, guys. Hi, Caesar. Hey, I know you, Caesar. You've been around. We're going to record it, Caesar. Is the delta difference between the high and the low of each candle tick? No, the delta difference, Caesar, is this line. It's the delta is simply the buy-sell imbalance in each candle when it's added like this. I don't want to give you vertigo. But we wait for the candle to close. You see that number? That number tells you the imbalance of aggressive buyers and the aggressive sellers on the bid-ask side of the Superdome. And if I show you the Superdome here, well, here's the dome. Now, the market's pretty much dead. So I'm not getting anything on here. Oh, I know why I'm not getting anything. It's the wrong crude contract. It should be crude here. And you can see there's the sellers. There's buyers, and it's telling you which is stacked more heavily. Traders looking to buy or traders looking to sell on the bid or the ask side. And it's giving you that number numerically here above each candle and putting that in a moving average. Now we could put that on the candles on the platform, but it wouldn't really, all it would do would just confuse us and you because it doesn't have any predictive ability. The system simply accumulates that data on the higher time frames. On the E-mini, it's the 8 and 13. On crude, it is the 13 and 21, and projects it into this bottom line of the 3 line. Right here, it's green across. It means the delta moving average of the 2 higher time frames is long. Here is short. There, and you see right here, there's your great trade where everything's red. Right here, great trade where everything's red. And that bottom line here is the delta moving average. Delta moving average. All right, let me see that. I hope that answers your question, Caesar. Yes, you will, Antip. You'll get it. You will get a. We'll send out a recording. The Forex, Bob, it works great. I don't have a Forex data feed attached. I can't show you the Forex markets, but the same forces that move price on the futures market or the stock market, they move it on the Forex market. It's identical. They're correlative Forex contracts. Giving you an assessment of money flow. And even though volume is assessed a little bit different, there's always a bid-ask side on the Forex markets, and they give you a delta moving average, and you get a really nice 3 line. There's no cash, obviously, cash equivalent. But the Forex markets, I used to trade the Forex I used to have a Forex trading room, which I opened in the middle of the night, but I just ran out of energy. And we got a lot of winners. Now, I don't even want to go into it, but the Forex comes with a it comes with a trade analyzer, and I'll show it to you really quickly. It gives you the ability to look at 12 Forex pairs at the same time. Let me show you real quickly. Here's the dashboard. It'll work here, I think. But I've got to take it out. See, what it does is, like what I used to do, what I would do is trade 12 Forex pairs at the same time, but I keep the charts closed. Let me wait for it to assess. And then what I would do is I would have the analyzer up. Now this is showing you, here's volume. This is the E-mini. And it's showing you the 15. It's showing you the quants. It's not working properly because this is a Forex analyzer. But when you get this alert, it tells you that all the independent variables I discussed are aligned and you're just about ready for a trade. So it really gives you a leg up, and you can trade a lot, and you can trade multiple Forex contracts and not have to have the bother of looking at all the pairs. Well, listen, John, it depends upon how much you make. I mean, if you make 600 a week, you made it today. 600, 1250. I mean, yeah, you can do it. And listen, if you want to trade a little bit more than 2 hours, you could have easily made $1,000 today, easily, if you just took the conservative entries. I don't know what the Christmas tree indicator is, Phil. The Christmas tree, that's very funny. Yes, we do, Phil. The 8 lines. Now I know what you're talking about. Yep. And let me tell you, you get used to this. Believe me, it is not hard to track us. Remember something. The middle lines on the 3 line are projected onto the candles. So the only thing you're really looking at is you're looking at the direction of money flow and the cash metrics. And if you're looking at crude oil, it's easier because there are no cash metrics. There's just the indicator for money flow, background bias, which you see on the chart, and the 3 line, which is projected right onto the candle. It is not that hard to follow. It's not to say you don't need some chart time, but once you've got it, I mean, you can see these trades coming quite a while before they actually hit. It's not that tough. Arthur, the reason we trade the 5 range on the E-mini, I like range bars simply because there's only one dependent variable in how they form. It's independent of time and it's independent of ticks. It's only dependent on market movement. And the 5 range is perfect if you look at the average true range and the volatility of this instrument. I mean, the 5 range gives us great entries, and we don't take a lot of risk on the trade, and we have the potential to make a lot. That's really all. If you trade time or you trade tick, you have 2 independent variables. Obviously, on a time chart, it's time and also the amount the candle moves. So I just really like to trade range bars. We have a range maker, and you can see it estimates where the candle is going to close to the upside and to the downside. So I just think it's really good for reading price action and market structure. I traded tick charts for a long time, and ultimately it does not matter. You can trade time and tick fine, and the system will give you great entries. But that's just my own personal preference. Arthur, it's all based on the average true range of the instrument, on the volatility of the instrument. On the NASDAQ, we trade a 13 range. On bonds, on notes, we trade a 3 range. So what we do is we do a 2-year assessment of the average true range. And there's an indicator called the ATR. And based on the ATR, it tells you how much volatility is inherent in the instrument. I mean, if there's a lot of volatility like the NQ, you trade a bigger chart like the 13. So it's just an optimized range setting based on how volatile the instrument is. I mean, you don't want to get now. You don't want it to be too fast, so you get you wind up getting caught up in chop, nor too slow, where it gets you into a trend trade late. And I think we've got the speed perfect just based on the ATR, on the average true range. And we have the average true range calculated for almost every stock and for all the futures markets. Like if you want to trade Google or if you want to trade Netflix, we'll give you the tick value if you want to trade range, but you can also trade time and trade tick. It's up to you. I'm not sure what you mean spot trading, Phil. Can you explain that to me? No Forex spot trading? I'm going to get down to your question, and then I'll be able to answer it again. It works on Ninja, James, and it also works on Sierra. I didn't project the Sierra just because I didn't want to confuse you, but I showed some Sierra slides. So it's operational on those 2 platforms. 5 range for ES. Again, Arthur, it's based on the volatility of the instrument. The more volatile the instrument, the higher the range. E-mini is a relatively low, like lately it's not been, but its average true range going back a couple of years calculates out to a 5 range based on our assessment. Crude an 8 range, the NASDAQ a 13 range, bonds and notes a 3 range. All the Forex are 5 range. So it's all based on the volatility, and it's based on math. No, it's not. Okay, no. Again, Arthur, it's based on the ATR, and I'll show you the ATR. So right here, see the average true range? This indicator gives you a really, really good assessment of the intrinsic volatility of the market. I mean, how high and how far is a swing likely to take place? Like, also the average true range. I don't see it here. I don't know why it didn't come down. Hold on a minute. I might not have clicked on it. The average true range also, here we go, also gives us the ability to set our targets and stops. Like our first target on the E-mini is a point, and our last target on the E-mini is 11 ticks, just shy of 3 points. And the way we set that is based on the analysis of the instrument's volatility. If you set it at anything else other than the math, here's the ATR. But what you have to do is you have to assess this over a period of we do it for 2 years. I mean, we run market replay at 500 speed, and it takes us 3 days to do an assessment of ATR. And we've created a formula that gives us the best range. And that's the indicator we use, the ATR. And if you look at the ATR on crude, or if you look at it on bonds, on crude, it's going to be more volatile. On the NASDAQ, it's going to be like crazy. So that's the indicator that we use. Hang on one second here. Is there a tutorial how to populate? Yes, there is, Caesar. There's a tutorial on how to populate the analyzer. I use it for options trades too. I have an options alert newsletter. Last year we did 105%. In the we had 133 closed out options trades. And this year we're off to an awesome start. Obviously now we're caught up in a little bit of chop. We have still 16 open positions in the options alert newsletter. This week I added 5 positions: Bristol Myers Squibb, General Dynamics. I can't remember all of them, but we added 5, all based upon the software. The reason I don't is because I only want to trade the number of contracts, and there's the alert going off. Now, it's not set up correctly. It's not working appropriately because this is a Forex analyzer. But that's what happens when everything aligns. The reason I don't, James, is because I don't want to trade more contracts than people in the room can afford. I mean, most of the traders in the room, we have a few who trade a 20 lot and a 15 lot on the E-mini. But I don't want to trade more than they do. So I want to try to get the exact same equity that they get in the room. So I trade 4 contracts on the E-mini and I trade 4 on crude. And you can do that with a modest size portfolio. That's all. And that's the reason that I do that. Hang on one second. Listen, I mean, if I wanted to pop, $1,000 today, I could have showed it. But it may be an amount of money that few people can make because they just don't have the money to put in their account. And what I want to show them is a reasonable amount of money they could have made on a modestly sized account. That's all. No, let me tell you, Phil, we're working on the auto trader for the Forex, but let me tell you why it's really hard. Because you can't trade the price on the Forex. Remember, you can optimize an auto trader for price, but there's a bid and an ask on the Forex. So if you optimize a Forex auto for the bid, it doesn't work. If you optimize it for the ask, it doesn't work. So what we're doing is we're trying to work out a way to try to get the price and not settle for the bid or the ask, whether we're taking a long or a short. That's what makes the Forex such a formidable instrument to auto trade, and why all these Forex engines are all bogus. Because you can't optimize for the actual price you want. You can only optimize for the bid or ask. And when I see them, it kind of makes me laugh because I don't know that anyone has beaten that yet. I mean, you know that in a market that's not heavily traded, the bid-ask difference is going to be wide. It may be 2 or 3 pips. So if you try to optimize for price, you're not going to get it. You're going to be in the trade 2 or 3 pips down. So that it's a real mathematical challenge to optimize for that. It's actual volume, Larry. It's simply volume at price. That's all it is, Larry. Actual accumulated volume at each pip value. And it comes right off the dome, right here. Thank you, guys. I mean, you're gonna get that right here. It's gonna give you a volume profile. Just taking it right off of here. All right, so listen, everyone, thanks for giving me your time. I really appreciate it. I hope you like the software. And listen, have a great, great afternoon. And I hope to see you in the room. If you have any questions or anything, just send us an email. We'll be more than happy to answer. We'll be here in the office all afternoon. So take care, and have a really, really wonderful day. I wish you guys all the best of luck. Let's make money in trading. And that's my goal every single day. Take care, all, and thanks again for your time. Bye-bye.